Welcome back to Focus Fridays, the series where we open up the playbook on real estate investing, from foundational concepts to the sophisticated strategies that help investors grow wealth with confidence. I'm Jared Shum, Head of Investor Relations here at Focus Capital, and I'm flying solo one more time. We're going to be talking about one of my favorite topics right now, investing in funds versus single asset syndication, the pros and cons of both. So as passive investors get more comfortable with real estate, this is one of those decisions that they eventually face, is to whether invest in individual deals, aka single asset syndications, or in a fund structure that pools capital across multiple assets. At first glance, this might seem like a minor structural detail, especially when people built up portfolios of their own. A lot of portfolios of single assets, they view their own capital as deployed across multiple assets. But the choice between single asset syndication vehicle and a fund vehicle touches almost every dimension of the investment experience that you'll have with the manager or sponsor. So how much transparency you have, how much control you retain, how much capital is deployed, what your tax documents look like, and then ultimately how your portfolio evolves over time. So both are legitimate and well-established structures, and both can deliver strong risk-adjusted returns in the hands of a skilled operator, but they behave differently, and the right choice depends heavily on what you're trying to accomplish, how much time you want to spend evaluating the investments, and where you are in building your real estate portfolio. So today we're going to break down both structures completely, what they are, how they work, and what real advantages and trade-offs look like between the two, and how to think about which one is right for you at your stage in your investing journey. So what is a single asset syndication? A single asset syndication is exactly what it sounds like. It's a discrete investment vehicle formed specifically to acquire, operate, and eventually sell one specific property. How it typically works is a sponsor, or also known as a GP or general partner, identifies a property, underwrites the deal, structures the financing, and then forms a new LLC or limited partnership to hold that asset. Investors are invited to participate as limited partners or LPs, contributing equity capital in exchange for a proportional share of the deal's economics, so cash flow, appreciation, and the profit at sale. This vehicle is purpose-built for that one asset. Once the property is sold, the vehicle winds down, proceeds are distributed, and the investment is complete. Investors who want to continue working with the operator typically have the option to roll into the next deal, but that's a fresh decision, not an automatic one. What makes a single asset syndication distinctive is specificity. Before you commit a dollar, you know the asset. You can review its location, its physical condition, its rent roll, its financing structure, its proposed business plan, and the comparable properties in the market. You can ask questions about the specific assumptions driving the projected returns. You're not betting on an abstract strategy. You're evaluating a concrete opportunity. So this format is the one that most investors encounter first in private real estate, and it remains the foundational of the middle market real estate investment industry. This is the format most investors encounter first in private real estate, and it remains the foundation of the middle market real estate investment industry. A vast majority of deals sponsored by operators in the 5 million to 50 million equity range are structured this way. Now, on the other side, we have the fund structure. A real estate fund pools capital from investors into a single investment vehicle, which is then deployed across a portfolio of assets, either identified upfront or acquired over time after the fund closes. There are several variations worth understanding. A closed-end fund raises a specific amount of capital during a defined fundraising period, typically 6 to 18 months. After the fund closes, no new capital comes in. The manager deploys that capital over an investment period, typically 2 to 4 years, and then operates and eventually exits the assets over the remaining fund life. Most closed-end funds target a 7 to 12-year total lifespan, with capital returned to investors as assets are sold. An open-end or evergreen fund accepts capital on an ongoing basis and generally doesn't have a fixed wind-down date. Instead, it offers periodic liquidity windows, quarterly or annually, where investors can exit at the fund's net asset value. So these structures are more common in institutional and larger scale vehicles. Another one worth mentioning is a blind pool. A blind pool is one where specific assets haven't been identified at the time that investors commit capital. So you're essentially writing a check to the manager's strategy and trusting them to find and execute on opportunities consistent within that strategy. A specified fund, by contrast, has identified some or all of the portfolio assets before the capital raise, which gives investors more visibility into what they're buying. It is worth noting that blind pool structures are not exotic or risky by definition. They're actually the preferred vehicle for most sophisticated capital allocators across the globe. Pension funds, university endowments, sovereign wealth funds, and large family offices are all regularly committing capital to blind pool real estate funds as part of their core alternatives allocation. They're underwriting the manager and the strategy, not the specific deal, and they've concluded that the diversification and deployment efficiency of the fund structure outweighs the reduced transparency. So that's a meaningful data point for any investor on how institutional investors think about this trade-off. Fund vehicles typically carry higher minimums than individual deals. On the low end, often at the 250 to 500K range, all the way up into the millions. And this reflects the institutional nature of the vehicle and the long-term capital commitment involved. That higher bar is part of what makes funds better suited for investors who are scaling a meaningful real estate allocation rather than just getting started. So what are the advantages of single asset syndication? So let's be specific about what single asset syndications deliver, because the advantages are real and meaningful, particularly for investors who are earlier in their investment journey. Transparency and specificity. You know what you're buying. This sounds simple, but it's a profound advantage for most investors who want to build real literacy in the real estate market. Every deal you evaluate teaches you something. It teaches you something about markets, about underwriting, about how operators think and communicate, and all of that learning compounds over time in a way that writing a check to a blind pool just simply doesn't. Deal-by-deal selection is another advantage. You can be genuinely selective. If a particular deal's market, asset type, or business plan doesn't align with your own thesis, you can pass without exiting an ongoing relationship with that operator. You retain granular ability to construct a portfolio that reflects your own views about risk and opportunity. And then you also have direct performance attribution. When the deal exits, the return is tied to that specific asset's performance, nothing else. You can evaluate whether the sponsor's underwriting was accurate, whether the projections held up, whether the execution matched their business plan, and a couple of other points there. So that accountability creates a much cleaner feedback loop than a fund where strong and weak performance blend together into a blended return. On minimums, we mentioned minimums in the last part, in my last point. These can vary by operator and institutional quality of the assets being pursued. At Focus Capital, our single asset deals start at 200K. Which reflects the profile of assets we acquire and the investor relationships we build. Across the broader market, operators focused on larger, high-quality assets typically set minimums between the 100K and 250K range. So that threshold helps filter for investors who are serious and appropriately capitalized for the opportunity. There are also obviously advantages to a fund structure. So fund structures offer a different set of advantages, and for investors at a certain stage of portfolio development, those advantages can be decisive. Portfolio diversification from a single decision. So this is the most obvious benefit, but it's worth stating clearly. A single capital commitment gets you exposure into multiple assets across multiple markets. If one property underperforms, a renovation goes over budget, a market softens, a major tenant situation emerges, the impact is absorbed across the portfolio rather than felt in full. For investors who have experienced the full weight of a single deal underperforming, this diversification is not abstract comfort, it's a real protection. There's also operational simplicity. Instead of evaluating, underwriting, and managing relationships with multiple individual deals, you get to make one decision to invest with a manager, and that manager handles everything. One subscription agreement, one set of reporting, one capital call process, and one K1 at tax time. For busy professionals managing a growing portfolio, this simplification is genuinely valuable. The cognitive overhead of tracking 12 individual deals, each with their own distributions, K1 timing, and reporting cycles, it can be taxing on busy professionals that have a established portfolio. There's also the capital deployment efficiency. When you're investing deal by deal, you're dependent on timing. Opportunities have to be available when you're ready to invest. Fund capital is typically deployed more consistently over an investment period, which means your money is working rather than sitting in a queue waiting for the right deal to come along. You'll also have access to larger and more institutional assets. Fund structures are the standard vehicles for acquiring larger, more complex assets that would be difficult to finance or manage through a single asset syndication format. Institutional quality multifamily, mixed-use developments, and large commercial portfolios typically live in fund structures, and access to those assets carries meaningful advantages in terms of pricing, management quality, and exit liquidity. So, as I mentioned earlier, the world's most sophisticated capital allocators, from sovereign wealth funds to university endowments to major pension systems, use blind pool fund structures as a cornerstone of their alternatives allocation. That's not a coincidence. It reflects a deliberate judgment that the diversification, deployment efficiency, and access to institutional quality assets that fund structures provide are worth the reduced deal-by-deal transparency. So, of course, we've talked about the advantages. Now, what are the real trade-offs and risks in each structure? For single asset syndications, the primary consideration is performance attribution. Your returns are tied to one asset's outcome, which makes operator selection and underwriting discipline especially important. A well-chosen deal with a disciplined operator in a strong market is a very different position from a poorly underwritten one, and there's no other asset in the portfolio to offset that difference. This is why single asset investors spend as much time evaluating the sponsor as they do the deal themselves. It's also worth thinking about single asset and syndications as part of a broader strategy rather than a standalone approach. So this structure works best when you're building exposure across multiple deals, potentially multiple operators, and multiple markets over time. The selectivity that makes a single asset deal attractive, being that you get to choose exactly what you own, becomes more powerful because you're applying it across a diversified portfolio rather than concentrating everything into one or two positions. There's also portfolio management complexity at scale. If you build a portfolio of 10, 15, or even 20 individual deals over several years, you're managing distributions, K1s arriving at different times from different operators, capital calls with varying timelines, and exit events that are largely outside of your control. This is manageable. Plenty of investors do it, but it's an operational consideration as your portfolio grows. For fund structures, the primary trade-off is transparency. In a blind pool fund, especially, you're committing capital before knowing exactly when it will be deployed. That requires a higher level of trust in a manager and a deeper prior evaluation of their track record. It's also a deeper understanding of their investment philosophy and their team quality. So for investors who are still building familiarity with real estate, this can feel slightly uncomfortable, and that's appropriate. There's also the fee structure complexity. Fund vehicles typically carry multiple levels of fees, management fees at the fund level, and potentially fees at the asset level if there are subsidiary structures, and then carried interest promotes on the back end. Understanding how those fees interact and what they mean for net returns require careful review of the fund documents. And then open-end funds, the liquidity profile deserves some scrutiny. Redemption rights that look attractive on paper can be gated, suspended, or delayed when market conditions deteriorate, which is precisely when investors are most likely to want liquidity. So understanding a fund's liquidity in terms of stress scenarios is an important part of due diligence. Now that we've kind of covered the pros and cons and the structures of the two, how should investors decide between how they're going to invest? So there's no universal answer, but there are a few useful frameworks for thinking about this decision. Experience and familiarity is one of them. So investors who are newer to private real estate typically benefit with starting with a single asset syndication. The transparency forces engagement with the specifics of the deal, which accelerates the learning curve, and you develop an intuition for underwriting, for market analysis, and for how operators communicate, all of which makes you a better evaluator of fund managers when you eventually move in that direction. Portfolio size and complexity is another point. As your real estate allocation grows, the operational overhead of managing many individual deals can start to outweigh the benefits of granular selection. So many experienced investors find that a hybrid approach works well. So maintain some individual deal exposure for the transparency and returns that it offers, while allocating a meaningful portion to one or two fund vehicles with operators that they trust deeply. And then you also have your time availability. So be honest with yourself. How about how much time you're willing to spend on an investment evaluation? A properly done individual deal review, reading the PPM, reviewing the financials, speaking with the sponsor, checking comparable transactions takes real time. If you're a busy professional who wants meaningful real estate exposure without significant ongoing time commitment, the simplicity of a fund structure may genuinely serve you better. That isn't to say that you can't be a passive investor in multifamily real estate single asset syndication. That's what our investors do, but you will have to evaluate a couple of more items per asset than you would in a fund that deploys over a handful of assets, when you only have to evaluate the investment thesis of that fund and the track record of the operator. There's also the relationship with an operator. And so in both structures, this is the most important variable. A fund with an exceptional manager operating with a strong alignment and transparent communication is a better investment than an individual deal with a mediocre operator. Similarly, a stronger relationship with an operator of a single asset is better than investing in a fund just because you want less operational overhead. If you don't know the operator, if you can't trust their investment thesis, if you don't know their decision making experience, then how will you know that when they come and call your capital and deploy it across those multiple assets, that you are going to be getting compensated for the risk associated with the returns? The structure is secondary to the quality of the people running it. That's the principle worth internalizing, regardless of which vehicle you ultimately choose. You may know which direction you're leaning and which investment vehicle you want to invest in. So what should investors look for specifically when evaluating each structure? For single asset syndications, the due diligence framework is relatively straightforward. You're evaluating a specific deal. The questions are, is the market strong? Is the business plan realistic? Are the underwriting assumptions conservative? Does the operator have relevant experience executing this type of deal in this market? Is the fee structure reasonable, and is it aligned? We've had past episodes that talk about how to evaluate all these parts. For fund structures, the evaluation shifts to a manager level. The questions become, what is the fund's stated strategy, and is it consistent and disciplined? How is the track record? Not just the headline returns, but the consistency, the transparency, and how the manager navigated periods where things didn't go to plan. How's the fund's fee structure designed, and does it create alignment with investors? What are the governance rights afforded to LPs, and what protections exist if the manager's performance falls short? One specific thing to examine in fund documents is the key person clause. So this provision specifies what happens to the fund if a named key principal leaves or becomes incapacitated. In smaller fund structures where the returns are highly dependent on one or two individuals, the strength and specificity of this clause matters. Those are the right questions to be asking. And honestly, there's a lot to hold on to from today's episode. We covered two distinct structures, their advantages, their trade-offs, and a full framework of how to evaluate each one. So before we wrap up, I want to point you to something that might be helpful. We put together a one-page visual breakdown of everything that I covered today, fund structures versus single asset syndications, side by side. It covers key differences, pros and cons, and a comparison table that you can use as a reference the next time you're evaluating an opportunity. You can download it for free using the link in the episode description below, and it's a good one to save. Something to keep in mind from this episode, if you were only to take one thing away, is funds and single asset syndications are tools. They're not verdicts. The best investors understand both structures deeply evaluate each opportunity on its own merits and make decisions based on where they are at in their investment journey and how much time they can commit and how much they trust the specific operator in front of them. What doesn't change across either structure is the fundamental evaluation framework: track record, alignment, transparency, conservative underwriting, and a clear understanding of how an operator gets paid. Master that framework, and the vehicle becomes almost secondary. Thanks for joining us today, and we'll see you again on the next episode. Thanks for listening to this week's episode of Focus Fridays. We release a new episode every week, so be sure to join us next Friday and beyond. If you'd like to see our next investment opportunity before it goes public, you can join our investor list by filling out the form on our website, focusedcapital.com. If you have any inquiries about what we've covered on our podcast, general real estate investing questions, or suggestions for the show, we'd love to hear from you. Feel free to reach out to us anytime by emailing us at investors@focusedcapital.com. Take care, and we'll see you next week.